Good day, guys. Sunday here again. You are welcome to this episode, another new episode. Like I promised us, I'm going to be giving us the information, the materials, the knowledge that we need to trade the financial market. I promise us I'm going to be giving us real information back to back so that we can start involving ourselves in the forex market. Because as we all know, forex market is one of the best market, one of the skill anybody can ever think of mastering, or it's a skill that when you acquire it, you will become, with time, you become financially free. But it is not a get quick rich something. You don't need to, have it in your mind that, oh, you just want to get rich fast. No, it's a gradual process. The most important thing is just have this mindset that, oh, you have acquired a skill that can help you have another source of income. So that should be what we should be thinking about, not just the financial aspect. Yes, it's something that is profitable. Once you acquire the skill and you are good at what you do, there is no two ways. There is no stopping you for you to get to a level where you become profitable. That is why I'm here to furnish us the right information that we need to be able to navigate the financial market, what we call the forex market. With this knowledge, you can trade any financial market. You'll be able to navigate your way through. On this note, I welcome you all to my YouTube channel, Having Forex. This is where we break down all the difficult, terminologies of trading. Like I told us, trading is a very simple thing. You just keep it, like my mentor will say, keep it stupid simple, because it's not something that is that difficult. Like we've heard, online, that is a very difficult thing. Yes, you need time to study, then practice what you have already learned and studied. You need to put it in practice. By so doing and spending time in mastering the chart, patterns formation, candlestick formation, candlestick pattern. And at the end of the day, you will now choose a particular strategy that you always, apply your day-to-day activities as you continue to trade the forex market. You cannot just be applying all the strategy. You must master at least one of the strategy, then you apply. What does that mean? Any day you want to trade, you have to wait for that your strategy to form. Once your strategy form in a very strategic level, resistance or a support level, supply and demand level, once your strategy, you see the formation like that, then you just place your trade. Once you master a particular strategy, that means you always want to wait for for you to see that strategy before you place any trade. That is how professionals trade. On this note, I want to welcome you all to today's topic, how to draw trend lines, because trend lines are something that we must learn how to do, because technically those are the things we need to be able to determine 3 points, when it comes to trending markets, uptrend, downtrend, be it ranging market, we must be able to master and learn how to draw trend line. Is very, very, very important. So to draw a quality trend line, all you need to do, you need to find at least 2 minimum 3 points and simply connect them with each other. What do I mean by that? Here is a picture, a graphical representation of a downtrend. We are familiar with what we call the impulsive move and the retracement move by now. So in the case of downtrend, we have the impulsive move to the downside, then retracement move to the upside. So you call it retracement or you call it pull back. So at this point, you can see this trend line. See, this is a trend line. You can see the trend started from here and it kept on going. Impulsive move, a retracement move, impulsive move, a retracement move, impulsive move, and a retracement move. You see, when you look at these two channels, these two lines, you discover that the activities are just centered inside this. Even if you see a little spark, that does not really mean anything, because at the end of the day, the activities are just in between. So by the time you map out this, you connect these levels, you will now know where the price action will likely get to before it makes another impulsive move. And when it's retracing, you know the level it will get to. Even if it spike above a little, you will now see, once you see the spark, if it spike out a little, you will see that there is a rejection. Automatically, that shows you that it will start another impulsive move. So to draw a quality trend line, you will need to find at least 2 minimum 3 points and simply connect them with each other. You just connect them. This is a swing point, this is a swing point, this is another swing point, this is another one. So you draw your trend line to link both. Let's say, for instance, a trend gets to this place. When you, as at the time you open your chart, the price action was stay here. And once you see the price action being here, all you need to do, you connect, you look at this one. Yes, he got to this point. There was a rejection. He made an impulsive move. He retraced back and it gets to this point. You now see a pattern formation that signals another impulsive move. So what you need to do is just to connect this thing and trace it into the future, meaning that once this impulsive move is completed, you are expecting this trend to have a pull back to this level. That is how professional traders trade. On that note, you will be able to identify your point of entry and where to put your stop loss. Then your target will be at the exhaustion of the impulsive move. You take your profit. You take your profit here. So our purpose is to identify, like what I've just told us, our purpose for drawing these trend lines is to identify the beginning of impulsive move in a trending market. As you can see, the market always respect the trend line, and by drawing it the right way, we can easily predict the next move. Just as I've explained to us, once you draw it, trace it into the future, you will now know the next move. You will understand that this place is always a turning point for another impulsive move. So continuation of bullish market, we tend to create a linear support level. Bearish market will form a linear resistance level. Now, this is a bearish trend. You see that this trend line is being linked here from the resistance level. Like we know, the upper side is the resistance level, while the downside is the support level. So if you flip the coin, you now discover that if the trend is going up like this, now this trend line will now be at the support level, meaning that in a bullish market, in a bullish market, in a bullish market, we tend to create a linear support level. It's a support level that the trend line will be at the support side, tracing it upward. So anytime price action gets to it, it will retrace, it will make an impulsive move. If you retrace to it, it will make an impulsive move. I hope we are clear with that. Then another thing is time frames and top-down analysis. Now, when we say time frame, like I've explained to us, we have in the periods, it depends on our involvement, our day-to-day activities, our normal life, everything centered based on our commitment, day-to-day activities. So you will now apply that to suit your time frame. Now, time frame, you have 1 minute time frame, we have the 3 minute, the 2 minute, we have the 5 minute, we have 15 minutes, we have 30 minutes, 1 hour, 2 hours, 3 hours, 4 hours, we have the 1 week, we have daily. So if you are the type that still, do your normal day-to-day job, that means you don't have time to check your chart. If you don't have much time to spend watching your chart, so maybe before you go to work, you must have done your analysis, arrive at a conclusion, then take a trading decision. So once you take a trading decision, you place your trade. So once you place your trade, you just shut down your computer and go to work. Maybe when you now come back, you now check, or on your phone you can check if your analysis was wrong or right. You will see it there. That means you don't have much time to spend on your chart. So as far as I'm concerned, you can decide to choose a daily chart, a daily time frame. That means each candle will print daily. One candle represents daily candles. That is a time frame for it. If it is 1 hour, a full candle represents 1 hour. If it is weekly, it is just one candle that will print every week. If it is 1 minute, after 1 minute, another candle will print. After 1 minute, another candle will print. So each minute represents one candle. If it is 30 minutes, for a candle to be fully printed, it has to be 30 minutes period. So it's like that. So in this chart now, you see we have the 15 minutes, we have the daily, we have the 4 hours. So it's like that. It now depends on the kind of your activities. If you choose the time frame that resonates with your daily activities, and of course, if you are the type that has taken this job as in your job, this is what you do, fantastic. What you need to do, maybe you just use the bigger time frame to do your analysis, then you now scale down to maybe 5 minutes or 15 minutes to do your trade execution. So top and down analysis means to begin with bigger time frame to get the big picture, and then you switch to the smaller one for trade execution. What do I mean by that? Now, for you to be able to determine the whether a chart is trending or whether it's bullish or bearish, for you to be able to determine the condition of a market at a particular time, it is always advisable to use the bigger time frame, like weekly. Open the weekly chart first, look at it very well. If it is bullish or bearish, you will see it very clearly. Then what you need to do is to map out the strategic level, what we call the support and resistance level, because price will always get to that point and turn back. There will always be a reversal, or if it's coming down to this support level, if it gets to that place, it will always reverse. You understand? So price always tend to respect that level, because that is where a support and resistance is a place, is a point where buyers and sellers always find equilibrium. So price always tend to respect that level each time price action approaches that level. So you open the bigger time frame to check first, to know what is actually doing, what is actually happening. Then you will now scale down to your time frame which you want to use for your trading execution. So that is how it is. Let's say you want to trade the 4 hour chart. You must look at the weekly and the daily chart. If the weekly and the daily chart analysis align with the 4 hour chart, anywhere you see H is hour. So if it's aligned with the 4 hour chart, you can then take your trading decision, like I've explained. If you want to trade the lower time frame, first of all, check the weekly, check the daily to see if the analysis align. You know, understand. Once you are able to identify, to come out that, okay, with a very concrete, affirmation that yes, the analysis are the same, you can now scale down to the lower time frame to do your trading execution. If you want to trade the 1H chart, the 1 hour chart, you must look at the daily chart first. This is critical process as a price action trader, because this will help you avoid, it will help you avoid low probability trading setups and give you high probability price action trader with good risk reward ratio. Let's say, for example, like I've explained, you want to trade 1 hour, but first you go to the bigger time frame to see if the chart, if it is bearish or trendy, if it is bearish or bullish, or maybe it's rangy or choppy, you will see it very clearly there. So by the time you check and you have ascertained, okay, this trend is bullish, that means you'll be looking for selling. If it's bearish, you'll be looking for selling opportunity. If it is bullish, you'll be looking for buying opportunity. Like I told us, if it is ranging, you trade from the bounce. Then you map out, draw your trend lines to support and resistance line, then you strike from there. If it is choppy, you stay away. It is advisable. So you first of all ascertain that. That is the first condition. Ascertain that first. Then you will now scale. If it is bullish or bearish, you will now scale down to the lower time frame. Then take your trading decision from there. Then you now place your entry. By so doing, you will now avoid lower possibility. You understand? And you will now embrace what we call a very good risk reward ratio. What do I mean by risk reward ratio? Like in trading, in forex trading, we always look for a good risk reward ratio. For example, if you are to place an entry, maybe at that point you now look at the next resistance level or the next support level is very close, but by the time you now put your tool to measure it, you now discover that it's just 1-to-1. What do I mean by 1-to-1? 1-to-1 simply means that, okay, let's say for example, I want to place a trade and the money I want to make is 50 euro. Because of that close support and resistance or support or resistance level, that is because once you place your trade, you have to take your profit just at the next support or resistance level. If it's bearish, you take your profit at the support, the next support level. If the trend is bullish, you take your profit at the next resistance level. That is how it works, because price can get to that level and reverse. Remember what I told us, that price tend to always respect resistance or support level. That means now when you now place your tool and now discover that if what you are likely to make is just, for example, 50 euro, and your stop loss, where you put your stop loss, is also 50 euro, you cannot do more than that. That means if your analysis is right, it will hit your take profit, that is 50 euro. You make 50 euro at that time frame. It could be 5 minutes, it could be 10 minutes, it could be 30 minutes, just like that. But if your analysis is wrong, you are going to lose 50 euro. So at that point, you don't take that trade, because it doesn't worth it. Because we always look at, professionals always look at, okay, I will always take a trade that has minimum of 2-to-1 risk reward ratio. What do I mean by that? Where I'm to put my stop loss, 50 euro. Where I'm to put my target point, my profit level, that is the next support or resistance level, is 100 euro. You understand? So if price action gets to my profit level, I've made 100 euro. If it reverses and hits my stop loss, I will only lose 50 euro. That means if you are to place a trade, like 3 trades a day, for example, you lose 1 and you win 3 and you win 2. That means you've won 200 euro, you only lost 50 euro. That means you have 150 euro as a profit for that day. That is how we trade. We don't trade 1-to-1 risk reward ratio. No, no. Except otherwise, you just want to, okay, this is 100% sure that, okay, after you have used all the confluences and now discover that, oh, this trade cannot reverse. You just want to just take it sharply. You can, it's advisable, but you have to be watchful so that there won't be a reversal. Because as it's going and you discover that it's going, and if there's a sign of reversal, you just exit. Even if it's 30 euro, 40 euro, you are able to, make at that period, you just take it. 40 euro is big money. 30 euro is big money too. Just under 3 or 5 minutes, depending on your time frame. So that is how it is, guys. The market structure. The weekly analysis will help you identify if the market is trending up or down, or it is ranging or choppy market. In general, you will know what the big investors are doing, and you will try to find a way to follow them on the smaller time frame using price action strategy, like we have explained. Before you make any trading decision, you have to scale up to the bigger time frame. There you will see the bigger picture. Because even the the investors, financial bodies, banks, financial institutions, what they do, they don't trade this smaller time frame. They trade weekly. What we mean by weekly is their time frame. What they do is they will they will put their entry, their stop loss and target, and just leave the system. Once price action gets to that place, you will see a very speed movement. That is how they do it. But what you do is you scale down to the lower time frame and follow them. It's like that. So I repeat, the market structure, the weekly analysis will help you identify if the market is trending up or down, or it is rangy or choppy market. In general, you will know what the big investors are doing, those financial institutions, government, um, financial bodies, you know what they are doing, and you will try to find a way to follow them on the smaller time frame using price action strategy. The previous candle, the last candle on the weekly chart is important because it tells us what happens during the week, and it provides us with valuable information about the future market moves. So by the time you open the weekly chart or the 4-hour chart, the last candle, that's why I told you the candlestick is very, very important because it represents all the activities, both the past and present. You understand? And it also gives you a hint of what will happen in future. So when you open your chart, the last candle, you have to know if the last candle, you have to be able to identify if the last candle, maybe it was bullish or bearish or maybe a dodgy candle. You have to be able to identify all that before you be able to navigate financial market properly. When you identify this points using the weekly chart, you can now move to the daily chart or the 4-hour chart and try to gather more information for your trading decision. Start from weekly chart, scale down to the daily chart, maybe 4-hour chart, 1-hour chart, just check and see if the analysis align. Then if you now like where you want to do your trading execution, you can scale down to 5 minutes, 15 minutes, 30 minutes, and place your trade because you have already established the condition. You have already done your analysis. Most important support and resistance level. These areas represent turning points in the market. If you can identify them on the weekly chart, you will know what is going to happen when the price approaches these levels on the 4H chart. Like I've told us, use the bigger time frame to draw your trend lines, your support and resistance line, because all those levels, price will get to that place and always respect that level. And what will happen is that as price get to that level, it will turn back. You will be able to decide either to buy, sell, or to ignore the signal you get from the market. Now, this is a trend, right? You see here, the trend was going up. It made an impulsive move. There's a retracement. It makes an impulsive move. Then this is a bearish engulfing candle. You can see this very one, this green one, is shorter than this red one. So this is to tell you that this is a bullish reversal. Like I've taught us already, this is a bullish reversal. What happens? There was a reversal, it moved down to this place. Now, this is what we call supply and demand. This is the sign for you to know that big players are in the market, they are involved. Why? Because you see that this candle will move in a just like a train. It takes off with a speed and you see it. You see a very long candle. Usually you rarely see long candles like this, you know. So as soon as there's a reversal here, it gets to this resistance level. What happens? It breaks through it. It gets to this support level, it breaks through it. And what happened? It breaks through it. There was a retest. It came down again. There was a retest. Then it started going downward. So you can see, by the time you look at this place, you discover that here used to be a support level. Why? Because he respected it once, twice, and three times. But the third one, he broke through it. But when he goes to this place, there was a pause. There was a pause. Why? Because he respected it before it started going down. And when it went down a little, it came back to it for a retest. Like I told us, anytime there is a break of structure, price action will always come back to it to retest the structure before it continues down or before it continues up like that. So it's like that, guys. It's very, very simple. All you need to do is watch the video clearly. Be very, very attentive. If there's anything you are not clear with, you rewatch it again. So, and don't watch these videos as if it's just normal video. No, this is something you need for you to be able to trade financial market successfully. I promise you guys. Then the market condition, what the market is doing on the 4-hour time frame. Is it trending up or down? Is it ranging or is it a choppy market? You'll be able to understand once you open your bigger time frame. Important key levels. This could be support and resistance, supply and demand areas. Now, I will treat support and demand because it's a topic on its own. But let me just give you a very simple way to understand what supply and demand is, and supply and demand and support and resistance, what they represent. Supply simply means aggressive selling. aggressive selling. You see that big candle that I showed us, like this one now, this is area where the bigger boys place their trade. They were just waiting for price action to get to this place. As soon as it triggered their entry, you see a very serious move to the downside. It's like that. It's like a moving train. Anytime it gets to their own point, because they always decide where they want to place their their trade. Because they have those guys, they have money, financial, but they have money. They use millions to trade, and they can decide where the market should go. That is why what controls the market, financial market, is what we call supply and demand. The supply simply means sellers. Demand simply means buyers. So it's like that. Supply simply means aggressive selling. Anytime you see a very big candlestick like this, you know that institutions are involved. You see aggressive selling to the downside. Demand means aggressive buying. Anytime you see movement like this in sequence, you just see green candle, green, 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 just going up. That is an aggressive buy. It started from here up to this point. You see, when it got to this point, he respected it. He is now doing consolidation, either to break through or to return back to the downside. So demand simply means aggressive buying. Supply simply means aggressive selling. Just get it into your brain. It's like that. Support and resistance are proven turning points where buyers and sellers find equilibrium in the forex market. This is what a resistance. Down here is support. As soon as it gets here, because why is it valid? We have one touch, second touch. The third touch must respect it. The same thing goes down here where you have the support level. So it's like that. Price action signal, a candlestick pattern that will provide you with an entry signal either to go long or short the market. When I mean going long means to buy. When I mean going short means to sell. Because there must be a candlestick formation, a pattern that I've already taught us that you will see at that support or resistance level that will tell you, okay, it is time for you to buy or it is time for you to sell the market. So it's like that. There will be a candlestick formation, a pattern. And those are the things we call strategy. Those are the things you will now, out of all those candlestick patterns that I've taught us, and we have more, I will still teach us as time goes on so that we know all. You will now choose one or two out of it as your strategy. So anytime you open your chart, all you'll be waiting for is the formation of that particular strategy. If you don't see it, most people trade like that. If they don't see that their own formation as a strategy because they have back tested it and it has been working marvelously well for them, if they don't see that formation, if they don't see that strategy, they don't trade. I have my own strategy. Once I open my chart, all I need to be doing is map out the supply and resistance level. I will identify the turning point and all that, the important levels. Then I will now scale down and wait for that formation. Once I see formation, I know what to do. So it's like that. This could be a pin bar. Your strategy, your pattern could be a pin bar. It could be engulfing, bullish engulfing, inside bar, tweezer tops and bottom, hammer, morning star, shooting or evening star. We have the shooting star, we have the evening star. We have the lower, low, lower close candle. We have the higher, high, higher close, and a doji. All these things are patterns, and you can apply them as strategy. All these are patterns that are widely traded as strategies in the financial market. So that is it, guys. Once you are able to master one or two of it, you now apply it in your day-to-day trading. Stick to one. It's not all of them that you are going to be trading. You say to yourself after back testing it. Back testing means you try it, your strategy. Try it for a period of time. You always take note of whatever happened, of the application. You apply the strategy and see if it works for you perfectly well. Once you see it working for you perfectly well, after the back testing, then you stick to it. If you don't see that formation, you don't trade. That is it. That is how to become professional in anything that you do. Just follow a pattern. Forget about the strategy that other people are using. Just stick to your own strategy. That is how it is, guys. On this note, I want you guys to know that I am trying hard to furnish you guys with the right information that will kick you start into, trading the financial market. And I want you to always watch the video, not once, because if you watch a video once, you might not get the real information that you are looking for. By the time you watch it another time, just like reading a book, you don't just read a book once and just believe you know everything that is in there. No, you have to read it again. So you watch the video again, then you take notes. Once you are able to take your notes, you should always refer to your notes. And trading is not limited to just guys alone. It has nothing to do with sex. So it is both men and women. Anybody can trade, provided you have your own system, your computer, or a telephone. You have a telephone with your internet, an Android or iPhone. Any phone that has an internet in it, you can use it. You can start with that. Later on, you will now buy your own laptop. So on this note, I would urge you guys to hit the subscribe button, share this video to your friends. Who knows, they might be interested, they might be thinking of how to learn how to trade in the forex market, but they don't know how to go about it. I am here to furnish you guys with the right information, and apart from that, I will keep it real simple. Like my mentor will say, keep it stupidly simple. That is how you trade successfully. Keep it real simple. And if you need one-on-one coaching, you be just send me a mail and we'll plan so that I'll put you in my planning, because I'm a very busy person. I'm a content creator. I make videos. I still do my normal job and I trade. So it's not easy. Once you contact me, then we plan on how to, we schedule. So that is just it. And my students right now, what we do, I map out time for the lessons that I'm dishing out to them. So that is it. Share my video, hit the subscribe button, like my video, and if you have anything, drop it at the comment section. On this note, I say thank you very much. God bless you guys. Be expecting another loaded pack. Like I told us, I will be giving us the real information that we need, the right one that we need, that will enable us, be successful in the financial market. So thank you very much, and God bless you.